So I'm not going to push anything. There are the slides are available at the end, and if you're interested in any of the research which underpins some of which I'm going to show, please scan the code, and I hope that's of help. I'll also show that at the end as well, just so you can have access. Okay, so I think today we've clearly talked about a lot of the underlying drivers behind the global investment environment, and I think they're especially pertinent across both developed and emerging markets. I think one of the things I want to reflect on today is just the increased role and the evolving role that private equity is playing in overall capital markets and overall investment markets going forward. We've heard about demographics and how that's really going to shape demand for certain sectors, consumer, healthcare, across the public and private space. But I think when we think about things in the context of AI, I think things get especially interesting because, of course, there's a lot of speculation right now, as we know, in the public markets about who the beneficiaries of artificial intelligence will be over the next decade. And I think from our perspective, it's going to be incredibly difficult to tell who the beneficiaries are. However, I think one thing that we're pretty sure on is that the chances of a disproportionate amount of that value creation being captured by private markets is quite high. So why is that? Because firstly, as we'll see later on, the percentage of the total equity market that's being taken up by private equity is growing. It's still quite low, but it's growing. And clearly, young, innovative companies are today more likely to be either private equity or venture capital backed, whereas when we look at the public space, we're dealing with a number of companies that are perhaps on the margin more likely to be disrupted by some of these trends that are coming through. So I think that's a really important trend to bear in mind when we think about the structure of the overall equity markets. Now, you can see on this chart here, both in terms of private equity and private debt, as I mentioned, the percentage of the total market that's made up of the private side has been increasing, and with our forecasts, which I'll show later, we think that percentage will continue to increase going forward, but it's still in absolute terms a relatively small part of the market. And if we think about that in a broader context, of course, when we look at equity markets, we've clearly had this very established shift towards passive and ETFs taking place on the one hand. We have active managers in the public space under pressure, but then we have the growth of private equity as well. So that's something that we expect to continue, and we think, quite frankly, there's even additional headroom or upside risk to our forecast because of the relative size of private equity today. Now, when we think about private debt, similar picture. So clearly, direct lending in the US in particular has really taken hold. And I think that a lot of the client feedback that we've had on the release of our most recent forecast is that actually it's private debt where clients are seeing additional upside risk, because when we look at the impact of Basel III and the implementations or the implications that has for appetite for private debt, that's one thing. But also we are generally seeing the potential for more bank disintermediation, which can lead to a lot of upside potential for debt. Now, just as a reminder of the opportunity set, if you look at the chart on the right-hand side, that's showing you the revenue split of companies in the US to take a proxy, and it shows you the mix of that revenue, how much is coming from the public space and how much is coming from the private space. And already we see we're pretty much split down the middle. But I think this chart really reminds us that when we think about the opportunity set that exists in private markets, it's an order of magnitude higher than the opportunity set available in the public space. Especially when we go down to the mid-market and the small end of the market, there are vastly more private, there's a huge number of, or order of magnitude higher number of private companies out there for private equity companies to go and look after. So I think the trend is pretty clear, and the opportunity set behind that trend is also still remains significantly large. Now, when we think about the performance of listed alternative managers, I think this really points out a few interesting trends. I mean, firstly, we have this ongoing trend of public managers getting increasingly involved in private markets because of these trends that are taking place. And it's really starting to show in terms of the performance of these managers themselves. So I know today we're talking about GP stakes. It's clearly a niche strategy which is starting to get some real traction. I think in that context, in that conversation as well, it's also really good to think about the listed private equity managers and the listed GPs out there, because the appetite for this investment strategy is clearly growing for these reasons. Now, you can see here, this is an extract taken from our investor survey responses that we conduct on a biannual basis. When it comes to investor allocations, the thing to keep remembering is that the appetite for private capital and private equity remains comparatively strong. So you can see here, in spite of the challenges that we have had over the last couple of years, both in the short term and the long term, we are seeing the majority of investors, of institutional LPs, either looking to increase their rate of deployment into the asset classes or maintain the current pace. So in spite of the challenges, the appetite is very strong. I think the challenge that we've clearly had over the last couple of years has been on the fundraising side, particularly due to the slowdown in exit activity that we've seen. And when we think about this in the context of fundraising overall, what we've really started to see is the market almost starting to split. We have those larger managers who may be listed, who are raising ever-increasing amounts of capital, and then we have other managers who are either doing very well because they're specialized and focused, but still finding it a very challenging fundraising environment. But you can see here the contrast between those established managers who are closing funds quicker, typically above target, and the emerging managers who are finding things more difficult. Now, on the right-hand side, you can see one of the main factors which is driving an increased amount of capital consolidation in the industry, which is the fact that fund sizes have increased overall. And that's obviously something that LPs are monitoring very carefully, because we have the potential for style drift in a number of strategies. But it's really only those large established managers who are doing this. So in many instances, the track records upon which the performance upon which that track record has been built is increasingly under question when you're raising funds which are significantly bigger than they were when you were building that track record. So what's that leading to? So we have seen an increased level of capital concentration, and I think from our view, unfortunately for emerging managers, it becomes increasingly difficult to believe that this trend will ultimately reverse. So one of the reasons behind that will be, we think, private wealth. It's an area of fundraising which is a part of the fundraising channel which is starting to get some real momentum now. But it's another area where a lot of that fundraising that is taking place in that channel is being increasingly concentrated on the larger managers. So this shows us the evolution of how each asset class has become more concentrated in terms of the amount of capital that's being raised. But we think that going forward, that's likely to continue as well. Now, just to wrap up, we did publish our forecasts a few weeks back, as I mentioned. We have separate forecasts for fundraising across regions and asset classes, and we've also started to look at individual strategies within that as well. The fundraising picture, in our view, will remain relatively challenging, and you can see that here. There's a very sharp contrast between what's happening currently and what happened in that post-pandemic environment, where we saw that huge run-up in activity overall, but both in terms of deal flow, exits, and fundraising. And we don't expect that environment to return for quite some time. So next year, 2025, we think the fundraising environment will be pretty similar, if not slightly softer than it will be this year. We're expecting a slight recovery in 2026, but it's not until the end of that forecast period where we really start to see things improve. Now, potential upside risks here are that private wealth is gaining momentum. We've seen a lot of these intermediary platforms raising a lot of capital through that channel. So that might provide additional upside risk. Obviously, the macroeconomic environment is improving, and it's better than we expected this time last year. If that continues, it may provide additional upside risk. Now, if we bring together our forecasts for performance and fundraising, we end up with our estimates for the overall growth of the industry. You can see here that we are expecting the growth rate of the industry to slow down. So in the most recent period, up until now, we've seen about 10.5% CAGR for alternatives as a whole. We think that's going to slow slightly. That's due to softer performance expectations and fundraising. But generally speaking, it's still pretty strong. And if you extrapolate these figures beyond 2029, it's pretty clear to see that we should be reaching 30 trillion by 2030, which is at least a good headline figure. So I'll leave it there. If you'd like access to the slides, as I said, please scan the code. And of course, all of this was taken from the research that's available as part of the Preqin Insights Plus subscription. So thank you very much.